Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Thursday, July 31st. Thursday's trading tone was set early with a pair of important economic releases. The advance read on second quarter GDP and initial claims for the weekend of July 26 were both released before the opening bell. The 1.9% increase in second quarter GDP was less than the expected 2.3% gain. However, this was due to a much larger than expected negative impact from inventories. The inventory calculation sliced a whopping 1.9% off the change. Real final sales, which economists consider a better measure of underlying demand, rose at a 3.9% annual rate. The underlying trends in consumer spending, business investment, exports, and government spending were generally better than forecast. Real personal consumption expenditures, that is, consumer spending, rose at a 1.5% annual rate. Non-residential construction was up at a 14.4% annual rate. Investment in software and equipment was weaker than expected, falling at a 3.4% annual rate. Strikingly, residential construction fell at only a 15.6% annual rate. That is down from about 25% the previous 3 quarters. This category is likely to go near flat in the third quarter, eliminating what has been a major negative on GDP. Government spending was up at a 3.4% annual rate, and exports continued to boom with a 9.2% annual rate of increase. The initial take on this number may be slightly disappointing, but the breakdowns of the trends is encouraging. The negative impact from inventories won't continue. It may well reverse in the third quarter, and if the trends in other categories remain reasonably stable, the third quarter real GDP increase will exceed 3%, as it would have this quarter were it not for the inventory calculation. The data are much stronger than the first glance suggests. Even at a 1.9% annual rate of increase, however, and with the third quarter now setting up very nicely for a strong gain, perceptions of the underlying strength of the economy should improve over the next few months. The other major economic release this morning was the initial claims report, which showed claims for the weekend of July 26 spiked 44,000 to 448,000. The latter was well ahead of the consensus estimate of 393,000 and marked the third time in the last 5 weeks the number has been above 400,000. Continuing claims rose 6% to 3.282 million, while the 4-week moving average jumped to 393,000 from 382,000. This suggests further weakening in the labor market that isn't comforting ahead of the July employment report Friday. This initial claims report is not an encouraging report, yet it should be noted the 4-week average is close to what we saw a month ago and is still below the 400,000 plus level that was witnessed for 29 straight weeks in 2003, during which time real GDP gains continued at a moderate pace. I'm Pat O'Hare for Briefing.com. Thanks for listening.